Hi there, tax accountants. I hope all is well, and I pray that as you are watching this video, that you're in the best of health and spirit. In this video, we're going to cover Chapter 4, Additional Income in the Qualified Business Income Deduction from Income Tax Fundamentals 2025. So in this chapter, we're going to take a deep dive into the other side of income, not just wages or interest, but we're going to learn about capital gains, rentals, and we're going to build upon what we learned in Chapter 3, business income and expenses, and we're going to explore self-employment. By the end of this chapter, you should be able to define the term capital asset, apply the holding period for long-term and short-term capital gains and losses, because we're going to come to realize that whether or not the holding period is long-term or short-term, it has a significant impact on a taxpayer's liability. We'll calculate the gain or loss on the disposition of an asset, compute the tax on capital gains, describe the treatment of capital losses, apply the exclusion of gain from personal residence sales, apply the tax rules for rental property and vacation homes, explain the treatment of passive income and losses. So as we know, there's three different types of income. We have active income. That is ultimately where, simply stated, if you don't work, you don't get paid, right? Especially if you are an hourly worker. God forbid, let's say I remember my first job was working at McDonald's. The days that I did not go into that job, I did not get paid. So that is active income. Also for certain individuals that are self-employed. If you are, let's say, a barber, or you are a hairstylist, or myself, I prepare taxes, have my own tax firm. In the event that, let's say, I don't have any staff and I do all the work on my own, if I don't prepare the returns, or the barber doesn't cut hair, the stylist doesn't do any hair, unfortunately, they won't make any money. So that's active income. Then we have what's called passive income, where you are passive in and of itself, the word. So that's like real estate. You have the building, and the building that helps to generate the revenue. There's not anything that you actively need to do to earn the income. And then we have portfolio income, and that's like interest and dividends. So we're going to explain the treatment in particular of how passive income is treated. We're going to describe the basic tax treatment of deductions for net operating losses. We're going to calculate and report the self-employment tax, both Social Security and Medicare portions for self-employed taxpayers, and we're going to compute the qualified business income deduction. So what is a capital asset? So the law defines by exception, so it's easier to remember what it is not. The tax law defines a capital asset as any property, whether used in a trade or business or not, other than stock in trade, inventory, or property held primarily for sale to customers in the ordinary course or trade of a business. So if we think about inventory, as we know, inventory are goods that are purchased by a business with the intent to resell it. So any type of property for which a company holds it with the intent to resell it, that is not considered a capital asset. Then we have depreciable property, or real property that's used in a trade or business. Patents, inventions, model designs, secret formula processes, copyrights, compositions, a letter of memorandum, or similar property that was created by the taxpayer, that is not considered a capital asset. So that's the key thing. If you purchase it from the person who created it, the person who buys it from the creator, to them it's a capital asset, but to the creator it is not considered a capital asset. Accounts or notes receivables and certain U.S. government publications, those are not considered capital assets. And in general, we know we live in this day and age where there's a lot going on with cryptocurrency. So virtual currency, even though it is intangible, it is treated as property. So capital assets, they're basically like your investment toys, right? But again, if you sell inventory, that's like selling the stock that's on your short sales. It's not considered a capital asset. So that's one of the key things. Inventory, anything that you plan to resell. Depreciable property, anything that was created by the taxpayer. Receivables and certain U.S. government publications, they are not capital assets. So again, the tax law defines by exception, and it is easier to remember what capital assets are not. All right. And unfortunately, a lot of times taxpayers, they think everything they sell is a capital gain, which is not true. Sometimes it might produce an ordinary gain. So as we go through the PowerPoint, we're going to learn that capital gains are taxed at preferential rates. However, ordinary gains are taxed at ordinary rates. So next we move on to the holding period. So this is very, very important. As I mentioned previously, the difference between long-term and short-term, it can mean thousands in dollars in taxes. So determining the holding period is the first step in the tax treatment of assets. The holding period for capital assets is how long the taxpayer owned the asset. Long-term assets are held for more than 1 year. So if it's exactly a year or less, then it's considered short term. So that is very, very important. So long-term assets, again, held for more than 1 year. So 1 year and 1 day. Short-term assets are held for 1 year or less. A capital asset sold before it is owned for the required holding period, it results in a short-term capital gain or loss. And unfortunately, short-term capital gains are subjected to ordinary tax rates. Capital gains and losses, they receive special tax treatment based on the length of time the property has been owned. And as mentioned, whenever there's a net short-term capital gain, unfortunately, it is treated as ordinary income. Therefore, it is subjected to ordinary income taxes. In regard to calculating the gain or loss, so the taxpayer's gain or loss is calculated, and we use this formula: the amount realized minus the adjusted basis is going to equal the gain or loss realized. So for example, you buy a car, you put some money into it, you make some upgrades, and then you sell it. So this is one of the important things. In the event that you buy this car, let's say you buy the car for $5,000 and you fix it up, you put some great enhancements, strobe lights. I don't even know if strobe lights can go on a car, but some people, they're really into cars and they really fix their cars up, put a lot of money into it, right? So let's say you have this car, you paid $5,000 for it, and you put another $5,000 into upgrading this car. In such case, your basis in the car is now $10,000. But unfortunately, what happens is a lot of times individuals, they do not track the improvements that they have made. So we have what's called the sale of the exchange. The sale or exchange of an asset results in a capital gain or loss. And although it's not defined in the tax law, a sale generally requires the receipt of money or the relief from debt in exchange for property. And an exchange is a transfer of ownership of one property for another property. The amount realized from a sale or other disposition of property is equal to the money you received plus the fair market value of any other property received less any transfer costs. If the taxpayer is relieved of a liability, then the amount of the liability is also added to the amount realized. And this is something we also see in the cancellation, right? So in the event, let's say you have a credit card and the credit card debt is removed, what do? They send you what's called a 1099-C, because I assume in the IRS's mind, all right, you just got $5,000 of credit card debt written off. If you had the money, you would have paid it off. So therefore, that $5,000 needs to be treated as income. So it is essentially the same concept. If the taxpayer is relieved of a liability, the amount of the liability is added to the amount received, is basically, treated as income, money coming in. So we would calculate the amount realized as follows: cash plus the fair market value of property received plus the liabilities assumed minus the selling costs, if any. And then we move on to the adjusted basis. The adjusted basis of the property is computed with this formula. So as mentioned, the original basis, $5,000 for the car that we purchased, plus the additional $5,000 of capital improvements. And then if we took any depreciation, we would subtract that. The original basis of property, it's usually the cost plus any costs incidental to the purchase, including settlement fees and closing costs. The settlement fees and closing costs, that more so alludes to real estate, but the same concept nonetheless. And then our capital improvements, these are expenditures that significantly result in an increase to the property's value or it lengthens its useful life. So some costs included in the basis, if there are charges for installing utility services, legal fees, recording fees, survey fees, transfer fees, owner's title insurance, and any amounts that the seller owes that the purchaser agrees to pay. So as we see here, we're more so dealing with real estate. And then costs that are not included in a basis would be any amounts paid in escrow, any premiums for casualty insurance, any rent for the property before closing, charges for utilities, or any charges connected with getting the loan. But ultimately, even though this is focusing in on real estate, same thing ultimately applies in general for any capital assets. Basis, as we see here, it depends on how the property is acquired. So this is very, very important. So basis, again, how was the property acquired? So if it was received as an inheritance, the original basis is generally equivalent to the fair market value at the time that the decedent passed away. And if it was acquired as a gift, the amount of basis depends on whether the property is sold for a gain or loss by the donee. So when you are essentially dealing with a client and they sell a property, these are the questions that you want to ask. The basis, again, it's ultimately going to be determined, how did they acquire the property? So here we have this quick example, and it states, calculate Juliana's amount realized and August 4, 2024, Juliana sold 326 shares of stock in Nanoplasma LLC that she had purchased on June 18, 2006. Her cost basis is $10,000. She sold the shares for $19,000 and paid a commission of $1,300. Calculate Juliana's amount realized. So here we see the amount realized is the $19,000, which represents how much she sold it for. And then we have the commission that she paid of $1,300. So therefore, her amount realized is $17,700. And then the realized gain is the amount realized minus the basis. We see her cost basis is $10,000. So therefore, she has a realized gain of $7,700. All right. So just to quickly go back with how the property was acquired, one thing that's missing here is obviously, the cost in the event that someone purchases something. So the basis of property, again, it depends on how the property was acquired. So if we purchase the property, basis is usually the purchase price, again, plus any costs. That's pretty straightforward for the most part. But again, when the property is received as an inheritance, the basis is going to be the fair market value based on the decedent's death. And that's what's called the step up basis. So unfortunately, what ultimately happens in such cases, or well, not unfortunately, what helps is that in the event that, let's say, I purchased a house for $100,000 and now the house is worth $800,000 and I pass away. So if we think of it logically, there's $700,000 worth of appreciation. So let's say I pass the house on to my son and he didn't inherit it. In such case, his basis would ultimately be my basis. So in such case, if it was acquired as a gift versus an inheritance, so in such case, when my son sells that home, let's say he sells it for $900,000, unfortunately, he is going to be paid taxes on my basis, which becomes his carryover basis of 100,000 in comparison to the 900,000. So he's now paying taxes on $800,000 versus if he inherited it, it's now going to be equal to the fair market value. So yes, I paid $100,000 for the home. The value is now 800,000, but because he inherited it, his basis is 800,000. He sells it for 900,000. He is only paying taxes on 100,000. So this is very important. Again, you want to ask the question, was it an inheritance? Was it a gift? Or was it a purchase? Because it has a very significant impact on what the gain or loss is going to be. And this is what a lot of wealthy individuals do. They ensure that they set up properties and trusts and things of that nature. So that way, when they pass on, their heirs can get the step up basis. So very important. So for those of you that have property, I would strongly, strongly suggest that you look into ensuring that your family members, the beneficiary, the heirs after you pass away, because not to be morbid, but that is the one thing that is guaranteed in life. I believe it was Abraham Lincoln or Benjamin Franklin, one of them, that said there are only two things that are guaranteed in life: death and taxes. Okay. And we're learning about both right now. All right. But again, the key thing to keep in mind is that, yes, if you have a property, you want to look into this, how to form a trust and things of that nature to ensure that your beneficiaries' heirs, they can take the step up basis, saving them in taxes when your time comes. All right, so now we move on to net capital gains. So as mentioned, whether the gain is long-term or short-term, it is very important. Why? Because it's ultimately going to determine how much you're going to pay in taxes. So the taxes on short-term and long-term capital gains, it can be a bit complex. The 2024 capital gains tax rates are as follows. So short-term capital gains, as mentioned, they're going to be taxed at ordinary income tax rates consistent with what your filing status is. As we know, there are 5 filing statuses. Either you are single, you are married filing joint, married filing separate, head of household, or qualifying widower. So when it's a short-term capital gain, your ordinary tax rates are going to apply. When it is long-term capital gain, so typical, in such cases, is going to be either taxed at 0, 15, or 20%, depending on the level of other taxable income. And then we have what's called long-term unrecaptured Section 1250 gain. This is capped at 20%. And then we have long-term collectible gain. So if you have art, you have gems, coins, stamps, etc., these are capped at 28%. And next we see the 3.8% Medicare tax on net investment income. This includes qualifying dividends. So this is essentially an additional tax that is charged for any net investment income, so passive income. And again, this includes qualifying dividends, and this applies to those high income that have income over certain thresholds. So a lot of times people, their complaint would be, hey, high income individuals, they don't pay a lot in taxes. There have been a lot of new taxes that have been introduced, and this 3.8% net investment income tax is one of them. And there are some ordering rules for capital gains, which is very, very important. So in the event that, let's say, someone sells, more than one item. So because there are multiple kinds of capital gains on which to calculate tax, it is necessary to order capital gains included in taxable income. And there's a specific order. So first we focus on short-term capital gains. Then we focus on unrecaptured Section 1250 gains on real estate, then gains on collectibles, and then we have long-term capital gains. So think of it like, the different shelves in a grocery store. Short-term is on the bottom shelf, ordinary rates, and collectibles are on a higher shelf, and they have a unique pricing. So some red flags is that sometimes students, especially from a individual perspective as it relates to taking exams or even in a profession, it is very, very important to remember the ordering rules. Now we look at, how we actually determine what the net capital position is, because maybe you have short-term gains and or losses, and then maybe you also have long-term. How do we figure it out? So the first step is to classify capital gains and losses as long-term or short-term, and then we net them by group. So we look at our long-term capital gains, and they'll offset our long-term capital losses. And then from there, we figure out what our net overall long-term capital gain or losses. And then we do the same thing for our short-term. Then we move on to step 2, and this is where we determine the net capital gain or loss overall. So in the event that our net long-term capital gain is offset by our net short-term capital loss, then in such case, maybe we have a net long-term capital gain, or maybe we have a net short-term capital loss. So our net long-term capital loss, this is where our net long-term capital gain exceeds what our net short-term capital loss was. Vice versa, if we have a net short-term capital loss, this is where our net short-term capital loss exceeds the net long-term capital gain. All right. And then the same thing at the bottom. This is essentially where we have a loss that offsets our capital gain. So ultimately, again, we start off by separating them from net short-term and net long-term, and then we combine the net short-term and long-term to determine overall, do we have a net long-term capital gain, a net short-term capital loss, a net long-term capital loss, or do we have a net long-term capital loss. And then we see, or it could be ordinary income. And in the event that the net short-term capital gains exceed our net long-term capital loss, then that is when we recognize it as ordinary income. So as mentioned, this area of tax law can be a bit complex. The great thing is that when you are working with clients that are selling their stocks, they'll receive a 1099 B, or they'll get like a 1099 consolidated. Let's say they have a brokerage account and they receive interest, they receive dividends, and a few other things. Then they'll just get one statement with everything versus multiple statements. But when they receive that 1099-B, that brokerage statement, it lists out, hey, Connie, let's just, say I'm making up a taxpayer, Connie, she stole 15 shares of stock for Apple. Her basis was 1,000 and she sold it for 2,000. $1,000 represents the gain, and then it also shows you when she purchased the stock and when she sold the stock. So we have these great tax softwares out there. So once we input the information, it would automatically do the work behind the scenes. We have this example. It says Chevril has the following capital gains and losses in the current year. We have short-term capital loss of 2,000, a long-term capital gain of 12,000, and a long-term capital loss carryover of 7,000 that was carried forward from a prior year. What is Chevril's net capital position in 2024? What are the tax implications for Chevril capital activities if he has adjusted gross income of $42,445 and his filing status is head of household? So as we know, for step one, we separate them. We only have one net short-term capital loss, which is 2,000, but then we also have a net long-term capital gain, and we also have a net long-term capital loss. So we net the two. So the 12,000 plus the negative 7,000 gives us 5,000 overall. So that's step one. And now step two, we combine the short term and the long term. So we have a $2,000 short-term capital loss and a $5,000 capital gain. So now when we net it, we have a $3,000 long-term capital gain. And because of Chevril's AGI, it is going to be taxed at 0%. And again, that is based on AGI, the taxable income, as well as the filing status, which is head of household. So this is a very powerful tool. And this is where, as a tax professional, you can provide value by ultimately providing your clients with tax planning services. So I have certain clients a lot of times. I remember one time they were planning on selling a rental property and they came to me first and they wanted to know, hey, if I sell the property, what will be the implications? So a lot of times, unfortunately, some clients, they have what's called closed transactions. They, did what they did. They sold the property, they sold the stock, and then they come to you after, but it's like, there's not much I can do. You already sold the stock, versus what's called an open transaction where they're thinking about it and they get the advice, they get the expertise, so that way they understand what the tax implications are going to be. Next, we move on to treatment of net capital losses. So net capital losses, short-term and long-term, they may be deducted against ordinary income in the amount of up to $3,000 per year. So it's like the IRS saying there's, no unlimited pity parties. Only $3,000 of your losses can reduce your salary income every year. So I'll never forget, I was someone sent me a video about someone giving some advice about selling stocks and with cryptocurrency and certain things like that, and they were saying, yeah, just sell it at the loss because it's not treated the way with wash sale and all of these things. And then ultimately, what the person did not mention was this $3,000 limitation. So unfortunately, there's a lot of information that is thrown out online on social media, and they only tell you one part. They don't tell you the other part. So imagine someone, they go and they decide to take advantage of the wash sale rules. So a wash sale, that basically happens when you sell a security like a stock. You sell it at a loss, and then you buy the same or a substantially identical security within 30 days, either before or after the sale date, right? So that provides what's called a 61-day window. So there's 30 days before the sale itself, and then 30 days after the sale. So the reason why this matters is that the IRS, they do not allow you to claim the loss for tax purposes in those types of situations. Instead, whatever the loss is just going to be added to the basis. So quick example, right? Let's say you buy a stock in company A for $1,000 and then you sell it for 700. So obviously you purchased it for 1,000, you sold it for 700. Now there's a $300 loss. And then 2 weeks later, you decide you're going to buy back the same stock from the company for 750. But because of the wash sale rules, the IRS, they're not going to let you deduct that $300 loss right now. So instead, what they're going to do is that they'll increase the basis in your stock, 750 for how much you paid plus the $300. So with cryptocurrency, they're not fully there yet. So ultimately what this person was saying was, hey, cryptocurrency rules doesn't aren't subjected to the wash sale losses, so take advantage of it. But then again, they didn't mention it. So imagine someone harvests about $10,000 of losses and they're thinking, wow, hey, I can write off this loss. They're going to be very shocked and very upset to realize that that $10,000 loss is actually going to take them about 4 years to write off, assuming they do not invest in any other stocks or sell any other stocks within that 4 year period. So again, some of the information you see online is great, but they don't always tell you the full picture. So I just wanted to point that out. So again, $3,000 per year, there is an indefinite carry forward. The nature of the capital loss, again, if it's short-term or long-term, it needs to be maintained when you are carrying it forward. So for those of you that love taxation, want to venture into taxation, whenever you are preparing a tax return for a new client, you always, absolutely always, at the very least, want to get the prior year tax return. Why? Because for the most part, most tax professionals, they'll provide clients with a sheet that details all of the carry forwards. If you're working with a client for the first time, they might not know that they have carry forward losses. So you use the prior year as a reference, so that way you'll see, hey, they have short-term capital losses or they have long-term capital losses, because again, they continue to carry it forward indefinitely rather. And if the taxpayer has both net long-term losses and net short-term losses in the same year, the net short-term losses are going to be deducted first. As it relates to the ordering rules for capital losses, when a taxpayer ends up with net capital losses, the losses offset capital gains using the following ordering rules. We have net short-term capital losses first reduce 28% gains, then 25% gains, then regular long-term capital gains. And net long-term capital losses reduce first the 28% gains, then the 25% gains, and any short-term capital gains. Losses from the sale of personal capital assets, unfortunately, they are not allowed for tax purposes, but you better believe that the gains are taxable. All right. So special rules for small company stock. An applicable percentage of gain in qualified 1202 stock can be excluded. And then we have section 1244 stock. All right, so as it relates to section 1202 and section 1244, so these are essentially areas within the tax law that they basically help small business stocks. So section 1202, the purpose of this section is that it rewards investors who hold stock in their small businesses long terms. And in order to qualify, they need to have issued stock from a C corporation, and they need to be a qualified small business stock. So what that simply means is that their assets were less than $50 million when they issued it. And then certain industries are excluded, unfortunately. If you have professional services like a CPA, don't qualify. Finance, hospitality. And what it basically means is that with section 1202, if they hold a stock for 5 years, they can exclude up to 100% of the gain, right? But there is an exclusion. It's capped at the greater of $10 million or 10% your investment. So this is a really big reward. Then with section 1244, this is where it like protects small businesses from the downside of risk. Because again, imagine you put your money into a startup company and stocks plummet, right? If we think of it from a perspective, if individuals knew, hey, wait, I'm going to invest $50,000 into this business, and in the event that there's a loss, it's going to take me upwards of 10-15 years to write it off. That would discourage individuals from wanting to take on risk and investing into corporations. So that's what 1244 helps to ultimately alleviate. So with this case, if you sell the stocks at a loss, you can deduct up to $50,000 if you're single as an ordinary loss. So it's not subjected to that $3,000 rule. And then if you're married filing joint, $100,000. So these are some really great areas of tax law. And again, as a tax professional, you don't just want to focus on tax preparation. You also want to venture into tax planning and projection so that way you can advise clients. And as it relates to reporting capital gains and losses, each item is going to be reported on what we have Form 8949, and then aggregated data is going to be reported on Schedule D. So I'm just going to quickly show you what Form 8949 looks like. All right, and then we also have, just so at least you can see what it looks like. So Form 8949, this is it. Sales and other dispositions of capital assets. It shows you, this is going to be attached with your tax return. This lists the name shown on the return, the social security number, and then you list out your short-term assets. You need to check A, was it reported on Form 1099-B? Was it, with the basis or not? And then maybe it was not reported on 1099-B at all. And then the next section deals with the long-term assets. So that's essentially what we would see on Form 8949. And then I'll also show you Schedule D. And then with Schedule D, this is where we report our capital gains and losses. So we have the name. And then this is where we essentially list the totals for all short-term transactions. So Form 8949, this essentially shows us the details of each transaction. In Schedule D, this lists out the totals, the overall. All right, so just wanted to show you what those forms look like. And in here, we move on to sale of a personal residence. So with the sale of a personal residence, there's a core rule. So there's an exclusion of up to $250,000 against income for gains on the sale of a personal residence. So again, imagine if you buy a home and then you sell it, and that would ultimately discourage people from wanting to sell their home, or even discourage them from wanting to buy a house, because they're like, man, if I buy a house and there's an increase in the value, there's an appreciation in value, I'm going to be subjected to so much in taxes. So with that in consideration, there's an exclusion for sales after May 6th, rather, 1997, that they can exclude up to $250,000 if they're single, and up to $500,000 if they are married filing joint. So again, imagine you buy a home for $200,000, you sell it for $500,000, and you don't need to pay taxes on the entire $300,000 gain. But obviously, there are some rules. So one of the rules is that you must meet what's called the 2 out of 5 year rule. So you need to live in a house for the past 2 out of 5 years. And in the event that, let's say, you have converted rental property, there are some, different rules around that. So beginning in 2009, Congress, they closed the loophole in the residence gain exclusion laws, and generally they'll limit the exclusion to the smaller of the $250,000 or $500,000 amount if the test of ownership and residence are met. So with that being said, let's say you get married and you guys move into the house. Again, there were some people that were taking advantage of these rules. So they closed this loophole, and ultimately they look at it, from both perspectives: before, when you were single, and now when you are married. That will ultimately determine if you take the $250,000 or the $500,000 amount. Next, we move on to rental income and expenses. So as we know, with the rental income and expenses, net rental income or loss is a part of a taxpayer's taxable income, and in most cases is going to be reported on Schedule E. So I'll show you guys what that schedule looks like. And this is essentially Schedule E. So Schedule E, this is for supplemental income and loss. And as we see, it's from rental, real estate, royalties, partnerships, S corporation, estates, trusts, remix, etc. So this is also attached to Form 1040, 1040 SR if they are a senior, 1040 NR for non-resident, or 1041, which is for trust. So it has your name, the income or loss from the rental, real estate, and royalties. It asks if you made any payments that will require a 1099. So this is like if you pay a contractor or someone to do work, you pay them more than $600, you need to file Form 1099. So here you would list the physical address of the property, The type of the property, is it single family, multifamily? Is it a vacation short-term rental? Is it a commercial space where there are office buildings, land, royalties, self-rental, other? You'll list the fair rental days, the personal use. Is it a qualified joint venture? And then from there, you'll list the income, whether it's rent or royalties, in boxes 3 and 4. And then from there, you'll list out all of your expenses. And then ultimately, you'll determine whether or not there is a gain or loss. And because, again, we spoke about passive activities, it might or might not be deductible if there is a loss. So that's Schedule E. When we have vacation homes, the deduction of expenses associated with a vacation home is limited based on the period the residence is used for personal versus rental purposes. And there's 3 categories of vacation homes, and the tax treatment differs for each of those categories. So we have primarily personal use, and this is treated as a personal residence if it is rented less than 15 days per year. Mortgage, interest, taxes, they're itemized on Schedule A. As we know, Schedule A lists all of our itemized deductions, and then any other expenses, they are considered non-deductible personal expenses. Then we have primarily rental use, and this is treated as rental property if it's rented for 15 days. The expenses, they're going to be allocated between personal and rental use. And you can deduct the loss against other income, but it's going to be subjected to passive loss rules, as we're going to learn in a few. And the personal percentage of mortgage, interest, and real estate taxes, they're going to be reported as itemized deductions on Schedule A. As it relates to rental, personal use, these expenses are going to be allocated between rental and personal. There's an allocable rental expenses. They're deducted in a certain order. First, we factor in interest and taxes, which is typically reported on Form 1098. Then we have utilities and maintenance, and then depreciation. One of the key things is that you must have positive income in order to deduct the rental expenses. And this is obviously in terms of it offsetting your ordinary income. And the personal percentage of mortgage, interest, and taxes, they're going to be itemized as deductions on Schedule A, and any portion that relates to the rental is going to be reported on Schedule E. So here we have this quick example. It's asking what amounts are going to be reported on Schedule A and E for the current year. It says the Mabel family owns a ski condo in Alta, Utah. In the current year, personal use is 25 days and rental use is 50 days. Data pertaining to the rental is as follows. So it gives us a hint. First, we need to determine what category is the condo in. Is it primarily personal use? Is it primarily rental use? Or is it personal and rental use? So in such case, since the condo is rented for 15 days or more, how do we know that? We see it's rented for 25 days and it's used for 50 days. So in such case, Mobile uses it for personal purposes for more than 14%, or 10% of the days rented. So therefore, it's going to be subjected to the vacation home limitations. So we factor in our gross rental income, and from there, we are going to subtract the taxes. So we see, if we scale back, that the personal use was 25, 50 days. Overall, we used it for 75 days. So we need to allocate it accordingly. So that is how we get the 75. So 4,500 represents the interest and taxes multiplied by the 50 days divided by the 75 days. So we subtract the interest and taxes of 3,000. And then from there, we factor in the other expenses, the total of 6,000. So if we go back, this is where we factored in all of the other things, the utilities, the insurance, the snow removal. That is how we get the 6,000. And then from here, we see the 12,000, which is the depreciation. It's 8,000, but it is limited to 3,000 because, again, we are staggering it. Interest and taxes come first, other expenses like utilities, and then depreciation. So ultimately, the net income is going to be 0. So with a vacation home, you cannot create a loss ultimately. So the interest and taxes, as we pointed out, allocable to the MBL family. Personal use of the condo is deductible as an itemized deduction on Schedule A. They get to take the 1,500 because, again, in total, they use the property for 75 days, 25 for personal, 50 rather for the rental. And then the rental portion of interest and taxes and other expenses, we ultimately, again, take the difference between the two. They're going to be reported on Schedule E. And then the $5,000 non-deductible portion depreciation, the great thing is that, yes, you're going to have to report net income of zero, but you don't lose it. The amount is just carried forward to the next year. And in the event that there is income in the future year, then you can take advantage of that carry forward. So similar to home office expense. Next, we have other rental issues. Security deposits to be returned at the end of the lease. They generally should not be included in gross rental income. Collection of rent in advance is generally rental income at the time of collection, regardless to what time period the rent is intended to apply. So this is something to also keep in mind. Yes, there's accrual basis and cash basis, but there are some nuances in the tax rules in regard to rent received in advance. Once you receive it, you got to pay taxes on it. Then we have expenses paid by the tenant on behalf of the rental property owner. Those would generally be included in rental income. So now we move on to passive loss limitation. So as mentioned, we already covered this, our active income. If you don't work, you don't get paid. Then we have our portfolio income. This is where your money is making money. We have dividends and we have interest. And then we have our passive income and losses. This is rental real estate income and loss passed through from a limited partnership, and other ventures in which the taxpayer has minimal or no involvement. When the taxpayer has minimal or no involvement in an activity, generated losses are passive and they cannot be deducted in excess of the passive income. Passive losses, generally, they cannot be used to offset active or portfolio income, and any unused passive losses can be carried forward and deducted in future years against passive income. And any losses that remain when the taxpayer disposes, when they sell their entire interest in the passive activity, then in such case, it can be used in full. Rental property, especially designated as passive, because as mentioned, you have the property, people are living in it. There's not much you need to do. Yeah, maybe, you need to fix the heat, or you might need to upgrade something in a home. But for the most part, you're not doing much. The property in and of itself is what generates the revenue. So in such case, when the taxpayer actively manages property, individual taxpayers, they can deduct up to $25,000 of rental loss against other income. But this is the key thing, if they are actively involved in the management of property. And this $25,000 loss, it is reduced by 50 cents for each dollar that the taxpayer's modified adjusted gross income exceeds $100,000. So simply stated, if the taxpayer's adjusted gross income AGI is more than $150,000, unfortunately, they do not get to take advantage of the $25,000 loss. There are some different rules that apply if the taxpayer is married filing separate. Next, we have real estate and rental as a trade or business. So now it's not just a passive activity, but this is your livelihood. This is your business. So taxpayers that are heavily involved in real estate rental activities, they can qualify as it having an active business. So instead of it being reported on Schedule E, it would actually be reported on Schedule C. In order for a real estate rental to be considered an active business, more than 50% of the individual's personal service during the year is performed in real property, trade, or business. They spend more than 750 hours of service performed during the year. And if both conditions are met, then the taxpayer, they can deduct the entire loss, because again, now it's not passive losses, it's active losses. So therefore, they can deduct the loss against their ordinary income. So we have this example here. It says Daphne, single, owns and actively manages a rental duplex, shows a loss of $20,000. Her modified AGI before the loss is $118,000. What amount of the rental loss can be claimed? How much can be claimed if her loss was $2,800? So again, her AGI exceeds $100,000. Therefore, she cannot take the full $25,000 loss. So we follow it or figure out the amount as follows: 118,000, which is her modified AGI, minus the threshold. She's $18,000 in excess. So therefore, she loses 50 cents for every dollar that is above the threshold. So 25,000, which represents the maximum amount, minus the 18,000 times 50%. Therefore, only $16,000 of the loss can be deducted. She loses $9,000 of the loss. If Daphne's loss was 2,800, then in such case, the full 2,800 can be deducted. All right, so I know we covered a lot so far. All right, now we're moving on to the last few subjects or concepts rather for this chapter. We move on to the net operating loss. So the net operating loss provision is primarily designed to provide relief for losses from trade or business and casualty and losses. So what this simply means, all items of income, deduction, gains, and losses, they must be categorized as either business or non-business related. So with our NOL, all right, let's think of it. You started a business and in year one, you had a gain of 50,000. And then in year two, you had a loss of 20,000, right? So in such case, you had a gain one year and a loss in another year. So with the net operating loss, this is when your business expenses are greater than your business income in a year. So simply stated, you spent more money than you made. So the reason why this matters is because with the net operating losses, Uncle Sam, the IRS, they let us use the loss to reduce taxes in other years. So simply stated, we can apply the loss in the current year to future profits and ultimately will pay less taxes a little later. So that's basically what our NOL means in plain terms. There are some rules related to the carry forward and carry back. So rules related to NOLs, they fall into three categories. We have the pre-2018 period. We have the 2018 to 2019 COVID-19 provisions, because during COVID, a lot of businesses, they couldn't operate as they wanted to. Things were shut down unless you were a necessary business. So there were lots of losses during COVID. And then we have post 2020. So the new Form 172, it has a structure much like Schedule A of Form 1045, and it captures the individual's NOLs starting for tax year 2024. There is what's called an excess business loss limitation, and this tax law places an annual limitation on non-corporate business losses. So when you hear non-corporate, it basically just means a business that operates in a form other than a C corporation, pretty much. So a sole proprietorship, a partnership, an LLC. After adjusting for inflation, the 2024 limits are 610,000 for married filing joint, and then one half of that, 305,000 for all other taxpayers. This limitation, it's in place through the end of 2028. It might change, it might not. We don't know. At this point, we pretty much just have to wait to see. Next, we move on to self-employment tax. So with self-employment taxes, that means that self-employed individuals, they are both the employer and the employee. So we have the Federal Insurance Contributions Act, FICA, and it imposes two taxes on employers and employees. We have Social Security, old age survivors and disability insurance, which is 6.2%, and we have Medicare taxes, which is 1.45%. As a self-employed individual, they are responsible for both the employee and employer portion. So 6.2 plus 6.2 gives us the 12.4%. The great thing with Social Security is that there is a maximum base. So once your income is above 168,600, you no longer pay taxes or you no longer pay Social Security taxes. Medicare taxes 1.45% for the employee and 1.45% for the employer. We add that together to get 2.9%, and it doesn't matter how much money you make, you are still going to be paying Medicare taxes. For self-employed individuals who also receive wages that are subjected to FICA taxes during the year, then in such case, the maximum base amount for self-employment taxes is going to be reduced by how much they make from their job. And this is one of the reasons why a lot of times employers, they prefer to treat workers as independent contractors versus employees. Because when you have an employee, You have to put them on payroll. And again, the employer is responsible for paying 7.65%. They have to pay Social Security 6.2 plus the Medicare tax of 1.45. So that's a lot of time why employers, they would misclassify workers as independent contractors because they can just pay them the gross amount and the individual will be responsible for their own taxes. But there are very hefty penalties and fines if that is found out. All right. So self-employment taxes, they're imposed on net earnings of $400 or more. Net earnings from self-employment income include gross income from a trade or business, less the business deductions, distributed share of a partnership from a trade or business, or any net income earned as an independent contractor. And in order to arrive at the net earnings, so some individuals might say, wait, what? Why would I want to start my own business if I have to pay the full amount? I have to pay FICA taxes, self-employment taxes for both myself as the employee and the employer. So, that would ultimately discourage people from wanting to start a business. So in order to arrive at net earnings, you get to take 1/2 of self-employment tax as a deduction. So ultimately, you are still treated the same way as though you were an employee because you get 1/2 of the self-employment tax as a deduction. So we have this quick example here. Zaria says she's self-employed. She's an accountant in 2024. From her practice, she earns $108,000 and has wages of $7,200 from a part-time job. And it is asking us to calculate her self-employment tax. So in such case, it's the $108,000 and we multiply it by 92.35. So you might say, wait, what? Why 92.35? So it's 100% minus the 7.65% that she is allowed to deduct. So therefore, the net earnings is $99,738. And then now for step 2, we need to compute the self-employment tax for Social Security and Medicare. And we know Social Security has a base for 2024 of $168,600. We subtract the FICA wages where Social Security and Medicare taxes are already being taken out. And then from there, we factor in the maximum self-employment tax base. From there, we subtract the lesser of the net earnings from self-employment after deduction or the maximum base. And then from there, we multiply it by the self-employment rate, and that gives us self-employment tax of $12,368. From there, we know Medicare, there's no tax. No matter how much money you make, you're still paying the 1.45%. FICA wages are not applicable, again, because there's no limitation. We multiply the net earnings from self-employment by the self-employment tax rate. So in total, Social Security taxes of $12,368 plus $2,892 for Medicare. The total self-employment tax is going to be $15,260. And again, we have what's called Form SE or Schedule SE rather. Once you input this information into the computer, it does everything behind the scenes. But again, it's not just about tax preparation, but from a tax planning perspective, you want to understand the nuances of what's happening in the computer so that way you can adequately guide and advise your clients. So this brings us to the last section, and we're looking at what's called qualified business income deduction. So with the Tax Cuts and Jobs Act, there was a very big change as it relates to corporate taxes. So corporations, much like individuals, they used to be subjected to progressive tax rate. So what that simply means is that the more money the corporation made, the more taxes they need to pay, much like individuals. However, corporations are now subjected to a flat 21%. It doesn't matter if their net income is $1, 1,000, $1 million, $5 million, doesn't matter. They pay a flat 21% tax rate. The issue, however, is that not all businesses operate as a C corporation. So therefore, this qualified business income deduction was introduced as a benefit to those that operate in a non-corporate business structure. So therefore, with the qualified business income deduction, the net amount of qualified items of income, gain, deduction, and loss relating to any qualified trade or business of the taxpayer in the U.S. QBI excludes the following: short-term capital gain or loss, long-term capital gain or loss, dividend income, interest income, any commodity transactions or foreign currency gain or loss, any items of income, gains, deductions, or losses that relates to certain notional principal contracts, and any amounts received from an annuity that is not related to a trade or business. So simply stated, with this QBI deduction, the tax law provides a safe harbor under which income from rental real estate, even if it's treated passive, it can still qualify for a QBI deduction. The requirements are there needs to be 250 hours or more spent by the taxpayer as it relates to that rental activity. There needs to be contemporaneous records of the time being maintained. So you need to have very good and very clear records. And then separate books and records for the rental activity must be maintained. So as it relates to the QBI deduction, very simply stated, is that if you are, let's say have income of $100,000, you get to take a deduction of 20%. So automatically off top, there's nothing you can do once you qualify and you don't meet any of the limitations, because QBI can become very complex. And at the very basic level, you get to take a 20% deduction. So the taxable income limitation, the QBI deduction, it cannot exceed 20% of the taxpayer's taxable income. There is a wage limitation for taxpayers that have taxable income above certain thresholds. So it's $383,900 for married filing joint, and $191,950 for all other taxpayers. And then the allocable share of W-2 wages is going to be subjected to limits. So there are certain phase outs. So QBI deduction can be very complex. But again, at the very surface level, it's 20%. The max is essentially 20% of QBI income, the qualified business income, or 20% of taxable income. And then we have specified service businesses limitations. So QBI from a service related trade or business. So unfortunately, doctors, accountants, tax professionals, there are some limitations that we are subjected to as it relates to QBI. And QBI is reported on Form 8995 and 8995. Form 8995 is for taxpayers whose taxable income before the QBI deduction doesn't exceed the phase out. But in the event that your taxable income does exceed the limitation, then they will use Form 8995A. So this brings us to the end of Chapter 4. So we defined the term capital asset. We learned to apply the holding period for long-term and short-term, and we learned why it is so important, because again, short-term capital gains are taxed at ordinary tax rates versus long-term. And if we are specifically dealing with stock, then it is going to be taxed at 0, 15, or 20%. We also learned how do we calculate the gain or the loss on the disposition of the asset. We need to figure out what is the amount realized and what is the adjusted basis. We learn how to compute the tax on capital gains. We describe the treatment of capital losses. Capital losses are capped at $3,000 a year. We applied the exclusion of gain from a personal residence. We applied the tax rules for rental property and vacation homes. We explained the treatment of passive income and losses. As we mentioned, there are 3 categories of income: active, passive, and portfolio. We described the basic tax treatment of deductions for net operating losses. So Uncle Sam says, hey, if you have a loss in year 2, you can carry it forward to year 3, and that loss from the prior year can offset income in the current year. We calculated and reported the self-employment tax, both Social Security and Medicare portions for self-employed taxpayers. And lastly, we learned a bit more about the qualified business income deduction. So this chapter helps to connect everyday real life, from selling homes to side hustles. And with advanced tax planning, again, as a tax professional, it is not just about preparing tax returns. You want to position yourself so that way you can advise clients. So mastering this equips you not just for exams and passing classes, but for real client conversations where you can provide value. So this brings us to the end of Chapter 4.